I have a chart which I'll show in a second when it comes to Treasury yields, and I know that's mostly monetary policy, but if you look at the Fed, I guess they also have to look at trade.
Yeah, sure. But I mean, one of the things where I do reckon you would see it is in the volatility, because, of course, one of the things that you do see in an environment where you have relatively calm sailing, volatility can come down. And one of the things that we have observed over the start of the year already is that particularly in the risky asset, be that credit or be that equity, vols realized and implied have gone up. So that's the way where I think we should see it. But frankly, even there, the implied volatility still tells us is all going to be okay. So I think the market is not really pricing a lot.
Peter Dixon, let me bring you over to my Treasury chart, which is great because we brought it back to, I think, 1961, something that Tom Keene will definitely appreciate. So this basically, we're asking ourselves whether the 30-year bond bull market is over. For our viewers and listeners, you can also go onto GTV Go and just take some of these charts and use it at your meetings. But if you look at the yellow line, the trend line, which was broken in the final quarter of 2016, having scratched above it in 2007. So how much, put that in perspective for us.
Well, I mean, obviously, if you extrapolate the yellow line, at some point you're going to go below zero, and that's not going to happen. Therefore, to an extent, we have to say that there is a limit as to how far bond markets can rally, and I mean, Peter's more of a bond market specialist than I am. But I mean, my view is that, given the absence of inflation in the US and indeed other economies, given the changes to the way in which the labour market seems to have operated, I'm not overly concerned about a massive pickup in inflation anytime soon. So, yeah, OK, yields have gone up a little bit, but I don't think we're going to see the next 30 years showing the same trend.
What about you, Peter Schaffrik? And at the same time, let me just bring you over there. So we have it on screen. That US 10-year yield is at 2.99. Is it a big psychological difference if it touches 3%? Well,
everyone is making such a big fuss about 3%. And frankly, I'm not that bothered. I was just on your radio show. And I don't really think whether it's 305 or 295, it really makes that big of a difference. The key for me, and it's going back to what Peter was just saying, the key for me is how does that come about? Because if we just have relatively low inflation and inflation expectations, and the Fed is just pressing ahead with their interest rate hikes, and then the real yields is shooting up, that's clearly a very strong tightening of monetary and financial conditions. And if that's the case, we will have an impact on the economy. However, we certainly at RBC believe that there's a very decent chance that wages do go up, that we do see not necessarily a resurgence of inflation, but certainly a return to more normality. And if that's the case, and if the break-evens go up, which are still underpricing long-term trends, then I think we have a very decent chance of staying north of 3% without being too disruptive.